Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. Imagine waking up, pouring your morning coffee, and finding out that the cost of doing business with your biggest international supplier just jumped by like 145% overnight.
Yeah, and the crazy thing is that is not a hypothetical scenario at all.
Right. Today, we are actually marking a pretty massive milestone. It's the one-year anniversary of those sweeping trade policies implemented under President Trump.
Exactly, the whole rollout of what was called Liberation Day.
Yeah, Liberation Day. And based on recent analysis, we are going to look at how the past 12 months have entirely rewired the mechanical infrastructure of the global economy.
Which is huge.
It is. Because trade policy usually sounds like, I don't know, abstract noise reserved for politicians in Washington. But this is a physical, mechanical shift. It is directly rewriting the rules for your wallet, your grocery bill, and your retirement account.
It really is. And, the biggest misconception circulating right now is that globalization just simply died over the last 12 months.
Oh, people definitely feel like it died.
Right, but if you look at the raw data, the global economy didn't fracture into these isolated little islands. Globalization didn't die. It just aggressively changed its address.
Changed its address. I like that.
Yeah, so our mission for this deep dive is to map out exactly how these massive physical and financial shifts are working behind the scenes. And more importantly, what those shifts mean for the everyday investor who is just trying to figure out where to put their money in this completely new landscape.
Okay, so to understand how the global map changed, I think we first have to look at the main artery of global trade, right?
Absolutely.
For decades, that highway has been the connection between the U.S. and China. Goods flow east to west, and dollars flow west to east. But based on the data from the past year, that highway has been fundamentally disrupted by these new policies.
Disrupted is an understatement. I mean, the disruption was unprecedented in modern economic history. Over the past year, the administration escalated tariffs between the U.S. and China to levels we honestly haven't seen in generations.
Right, because at its peak, the data shows that U.S. tariffs on Chinese goods hit a staggering 145%.
Yeah, 145%. Eventually, they did partially ease after the market experienced a severe shock and, some back-channel negotiations took place.
Sure.
But that 145% peak is the crucial piece of the puzzle here. When a tariff hits that level, it completely breaks the foundational math for a business.
Yeah, I mean, let's unpack this. If I'm a CEO making household electronics, I can maybe absorb a 5 or 10% tax, right? Trim some internal costs, keep selling.
Exactly.
But 145%, that is more than the cost of the actual product. It makes direct U.S.-China trade completely financially unviable. It's like driving on a major interstate and seeing a massive deep red traffic jam on your GPS app. That jam is the 145% tariff.
Right.
You don't just put your car in park and live on the highway. Your app automatically reroutes you through a dozen complex back roads to get to your destination.
That GPS analogy works for the immediate intent, but it kind of falls apart when you look at the timeline and the actual cost.
How so?
Well, a navigation app reroutes you in 2 seconds for free. Rerouting a global corporate supply chain takes 5 to 10 years and billions of dollars in new capital expenditure.
Oh, wow. Yeah, you can't just move a factory overnight.
Exactly. You can't just drag and drop a massive electronics factory from Shenzhen to another country. You have to pour concrete, train a completely new labor force, build power grids, establish new shipping routes.
So what are companies actually doing then?
We are actually seeing 2 distinct strategies in the data. The first is nearshoring, where companies are enduring that painful, slow-motion process of physically moving manufacturing to places like Monterrey, Mexico, or Ho Chi Minh City in Vietnam.
But wait, moving a factory takes years, as you just pointed out. And these tariffs hit 12 months ago. Are companies actually packing up and moving that fast, or are they finding some kind of shortcut?
That brings us to the second strategy, which is transshipment.
Okay, transshipment.
Yeah. Rather than building a brand new factory, some Chinese manufacturers are simply shipping their nearly finished goods into Vietnam or Mexico, doing the absolute bare minimum of final assembly, slapping a Made in Vietnam label on the box, and just sending it over the U.S. border to avoid the tariff.
So the globalization engine is still running. It's just taking a highly inefficient, legally complex detour to get to your front door.
Exactly. The data clearly shows that direct trade volumes from China to the U.S. have weakened, but the total volume of global trade hasn't collapsed at all. Third-party countries in Eastern Europe, Malaysia, India, and Mexico are acting as the new middlemen.
Which means if I'm an everyday investor analyzing a company for my portfolio, I shouldn't just be looking at their quarterly sales numbers anymore.
No, not at all.
I need to be digging into their operational reports to see if they are actually building resilient supply chains, or if they're just relying on flimsy transshipment loopholes that could literally be closed tomorrow.
That is the exact analytical shift an investor needs to make today. The long-term winners in this economy are the countries and companies investing real capital to build permanent alternate trade routes.
Rather than just temporary workarounds.
Exactly.
Okay, so if corporations are spending billions to physically reroute their supply chains, we also have to look at how whole countries are behaving. Because, I mean, if you read the headlines, it sounds like our closest national allies are simply abandoning the United States. Are they just running away to form their own economic blocs?
Well, the headlines definitely tend to lean into panic, right?
Yep.
But the underlying macroeconomic data tells a story about risk management, not abandonment.
Risk management, okay.
Yeah, our allies aren't operating out of anti-American sentiment. The U.S. still possesses unparalleled military strength, a massive tech edge, and a consumer base that practically drives the global economy.
Right, everyone still wants to sell to Americans.
Exactly. What these allied nations are doing is moving away from single dependency. They learned over the last year that relying entirely on U.S. trade policy remaining stable is just a massive vulnerability.
We can see that happening in real time with our closest neighbor. Historically, Canada's economy has been deeply, almost entirely intertwined with the U.S. market.
Oh, heavily intertwined.
But recent February trade statistics revealed something wild. Canada's export share to the United States hit a historic record low, while its non-U.S. exports hit a record high.
Yeah, so that February data is a perfect example of how you have to read economic indicators critically.
What do you mean?
The overall trend of Canada diversifying away from the U.S. is very real. But that specific February spike in non-U.S. exports was heavily skewed by gold shipments.
Wait, gold?
Yeah, gold has a massive value-to-weight ratio and is often moved in bulk by central banks to settle accounts or hedge against currency fluctuations, and that can temporarily distort monthly trade volumes.
So the sheer dollar value of the gold made it look like Canada suddenly started exporting millions of everyday goods to the rest of the world, when in reality it was just a few heavy shipments of bullion.
Correct. But, and this is key, if you strip out the gold anomaly, the baseline trend remains undeniable. Canada is actively working to shrink its exposure to U.S. political and trade risks.
Wow.
We are seeing the Canadian finance minister engaging in direct dialogue with China to restore agricultural trade that had been frozen for years. And they are also expanding their reach into the UK and the broader European market.
I mean, it makes sense from a survival standpoint. It's like having a backup internet provider.
Oh, that's a good way to put it.
Yeah, like for your home office, you still love and rely on your primary provider because they offer the fastest speeds and the biggest bandwidth. But if that main connection starts dropping randomly because the provider keeps changing their infrastructure and your livelihood depends on being online, you are going to pay for a secondary router just in case. You aren't throwing the primary router in the trash.
Yeah.
You just can't afford a single point of failure.
Exactly. And that secondary router strategy is happening on a massive scale across the Atlantic, too. The European Union and India are accelerating the exact same type of backup plan.
The EU and India.
Yes. Based on recent research, the EU actually rushed to expedite a massive free trade agreement with India right after this new wave of U.S. trade policy started. We are looking at a goods trade relationship between the EU and India that was already valued at 120 billion euros in 2024.
That is massive.
And projections now expect EU exports to India to nearly double by 2032.
Doubling the trade volume between two massive economies in less than a decade? That requires a monumental amount of physical infrastructure. Can India's ports and roads even handle that kind of influx from Europe?
Well, that is the multi-billion-dollar hurdle right there. India is pouring capital into port expansions, rail networks, and digital logistics just to absorb this manufacturing shift.
And the EU is just okay with dealing with those growing pains.
They are willing to endure it because India represents a massive democratic market that acts as a vital counterweight. The European Union is strategically maneuvering so it doesn't end up crushed in a pure bilateral standoff between the U.S. and China.
So when an investor looks at allied foreign markets, the question to ask isn't whether they are politically loyal to the U.S., The question is how effectively they are hedging their reliance on U.S. policy.
Spot on. That is exactly how you have to look at it.
Okay, so all of this rerouting and backup planning sounds incredibly expensive. Someone is paying for all these new ports and transshipment detours. Who is actually picking up the receipt for these tariffs?
Well, the bottom line is that the U.S. consumer is bearing a massive chunk of it.
Yeah, because we saw a crucial stat from the research. The 2025 tariffs acted like an effective tax increase of about $1,000 per U.S. household.
Yes, $1,000 per household.
And here's where it gets really interesting for anyone trying to understand the basics of this. Tariffs aren't a bill that the foreign company just pays directly out of their own pocket.
No, not at all.
It's basically like a restaurant cover charge. If the restaurant's landlord raises the rent, the restaurant doesn't just absorb the cost. They just increase the price of your burger by $5. Ultimately, you pay it.
Exactly. And macroeconomic data backs this up entirely. The U.S. trade deficit actually widened in February. Tariffs are raising production costs and import prices across the board.
And that just trickles right down to the grocery aisle.
Right. And it's creating investment uncertainty, which heavily burdens the U.S. consumer, especially when you combine it with energy costs rising due to geopolitical conflicts in the Middle East right now.
Right. Gas prices go up, food prices go up. So if tariffs are costing consumers this much, is anyone trying to stop them? This leads us to the legal whack-a-mole that's been happening.
Oh, the legal battles have been fascinating. It's an aggressive structural stress test of presidential power.
Yeah, because on February 20th, the Supreme Court handed down a ruling that actually blocked President Trump's blanket tariffs. The president had initially imposed these sweeping tariffs using a piece of legislation called the IEPA, right?
Yes, the International Emergency Economic Powers Act.
Okay, so for the beginner listener who doesn't have a law degree, what exactly is the IEPA and why did the Supreme Court say no?
So, the IEPA is a law from the 1970s. It was generally intended to give the president power to freeze the financial assets of foreign adversaries or terrorists during extreme, extraordinary national security threats.
Like actual wartime emergencies.
Exactly. And the Supreme Court essentially ruled that the administration cannot stretch a law meant for extreme national emergencies to just impose broad, standard economic taxes on everyday imported goods. It was a major procedural defeat.
But wait, so what does this all mean? The prices of imported goods didn't suddenly drop back to normal on February 21st? Did the tariffs just go away?
No, they did not. The administration immediately pivoted. That's why we call it legal whack-a-mole. The very same day the Supreme Court closed the door on the Emergency Powers Act, the administration invoked a completely different legal mechanism.
What did they use?
Section 122 of the Trade Act of 1974. They used it to implement a 150-day temporary 10% global tariff.
How does Section 122 work differently than the Emergency Powers Act? I mean, a tariff is a tariff, right?
Right. But legally, Section 122 is essentially an economic accounting provision. It allows the president to impose temporary tariffs if the United States is running a severe balance of payments deficit.
Meaning more money is leaving the country to buy imports than is coming in from exports.
Precisely. So the administration simply swapped out a national security justification for a strict accounting justification.
Okay, so they just found a new loophole.
Yep. And alongside that, they launched targeted investigations under Section 301 and Section 232, which deal with unfair trade practices and specific national security impacts on certain industries. If the court strikes down one legal framework, the administration just activates another to maintain the tariff structure.
Wow. Which means the underlying cost to the consumer remains, just under a different legal name.
Exactly.
And this brings us to what I think is the most complex and aggressive policy shift of the past year. The April 2nd pharma drop.
Oh, this was huge.
Yeah, this happened exactly on the one-year anniversary of Liberation Day. We aren't just talking about a broad tax on steel or plastic anymore.
Yeah.
The administration announced up to 100% tariffs on imported brand-name prescription drugs.
The April 2nd pharma measure is a fundamental evolution in how tariffs are deployed. It is the complete weaponization of industrial policy.
Weaponization, yeah. Because it's not a blanket tax, right?
No, this isn't a flat tax meant to generate revenue. It is a highly engineered tiering system designed specifically to force foreign pharmaceutical companies to the negotiating table.
Okay, let's walk through the mechanics of this tiering system. If I am a major pharmaceutical company based overseas, how do I avoid this 100% tax on the medications I sell to American hospitals?
Well, the policy dictates strict conditions for what they call compliance. To get your tariff rate dropped to 0%, your company must fully comply with two major demands. First, you have to physically manufacture a significant portion of your active pharmaceutical ingredients, the actual chemical base of the drugs within the United States.
Okay, so bring the jobs here. What's the second demand?
Second, you have to agree to the administration's pricing caps on what you charge American consumers.
So the administration is basically saying, build the factory in our backyard, sell the pills at the exact price we tell you to, and we won't tax you.
That is the ultimatum. If the pharmaceutical company only partially meets those demands, like maybe they agree to the price caps but absolutely refuse to move their factory, they get hit with a 20% tariff.
And if they just say no entirely?
If they refuse to alter their operations entirely, they face the full 100% tariff penalty, which essentially prices them out of the American healthcare market completely.
That is aggressive. Does this apply to every country across the board, or are there carve-outs for our friends?
There are highly strategic exemptions. Allied entities like the European Union, Japan, South Korea, and Switzerland actually have their brand name drug tariffs capped at 15% due to pre-existing international trade frameworks.
Okay, so they get a bit of a break.
Right. And interestingly, the UK managed to negotiate a separate standalone agreement that grants them 0% tariff-free access.
Oh, wow, 0% for the UK.
Yeah, which really shows you that trade policy is no longer just about macroeconomics. It is a surgical tool used to reward specific allies and punish specific corporate behaviors.
So if you are a beginner listener looking at your 401k or your brokerage account right now, you are probably trying to make sense of all this.
It's a lot to take in.
It is. We have supply chains undergoing billion-dollar relocations to places like Vietnam. We have Canada and the EU building massive backup trade networks with India. We have the American consumer absorbing thousands of dollars in hidden costs at the retail level, and we have an administration playing legal whack-a-mole to enforce 100% tariffs on prescription drugs.
Right.
With all of this friction and increased cost, why hasn't the market completely collapsed? I mean, why did the U.S. dollar actually rise 1.6% in the first quarter of this year?
Well, to understand the strength of the dollar amid all this chaos, you have to synthesize the global picture. The primary consequence of the last year isn't just higher consumer taxes. It is the death of predictability.
The death of predictability.
Yes. For decades, investors built their financial models on the assumption that global trade was stable, predictable, and constantly moving toward fewer borders. That era is over. Policy is now a fluid, localized risk factor.
And when predictability dies on a global scale, capital gets scared, right? It looks for the safest place to hide.
Exactly. And the safest place on Earth to park capital is still the United States. Despite the internal legal battles and the shifting supply chains, the U.S. economy remains deeply resilient.
Luckily, we have energy.
Right. Yes, the U.S. is fundamentally energy independent and is a massive energy exporter. With geopolitical conflicts in the Middle East currently driving up the global cost of energy, the U.S. dollar benefits from a significant premium.
Makes sense.
Capital flows into the dollar because it represents security in a fractured world. It is not a story of American decline. It is a story of intense American complexity.
So if the playing field is permanently more complex and unpredictable, what is the golden rule for the everyday investor trying to pick stocks today?
The golden rule moving forward is prioritizing resilience over cheapness.
Resilience over cheapness.
Over the last 20 years, the stock market rewarded companies that found the absolute cheapest place on earth to manufacture a product, regardless of the political risk. That model is dead. The companies that will dominate the next decade are the ones that build supply chains tough enough to survive a random 145% tariff threat.
Which means looking for companies that have already spent the capital to diversify their manufacturing across multiple countries. Or companies that have such strong brand loyalty that they could just pass a 15% cost increase onto the consumer without losing a single sale.
Those are the fundamental traits of a modern, policy-proof company. You have to look past the political noise of the daily headlines and focus strictly on the physical mechanics of how a company sources its materials and delivers its product.
We have covered a massive amount of ground today, from the realities of nearshoring versus transshipment, to the hidden costs at the retail checkout counter, to the weaponization of pharmaceutical tariffs. It is a completely new map.
It really is. And I want to leave you with one final thought to ponder as you navigate this new environment.
Let's hear it.
We have established that global supply chains are being physically rebuilt from the ground up. Companies and countries are prioritizing political survival and operational redundancy over pure economic efficiency.
Right.
So, if the entire globe is permanently accepting higher manufacturing and shipping costs simply to guarantee stability, are we entering a new historical era where a certain higher level of inflation is just permanently baked into the global economy? It is something to consider the next time you pick up an imported product at the store and notice the price has crept up again.
A permanently more expensive world, just to ensure the shelves stay stocked. That is a heavy but vital perspective to keep in mind. Thank you all for joining us on this deep dive into the mechanics of the new economy. Don't forget to subscribe and hit that like button.